It's a Tuesday morning. You wake up, grab your phone, and open your banking app like you do every single day. But this time, the app won't load. You try again. Nothing. You turn on the news, and there it is. The bank you've trusted for 15 years, the one holding your entire life savings, has collapsed overnight. 48 hours ago, this bank had over $100 billion in assets. It had glass towers, thousands of employees, and a logo you saw every single day on your debit card. 48 hours later, it doesn't exist anymore. And here's the part that should scare you a little. This isn't a hypothetical story. This exact thing happened in 2023 to a bank that was bigger than most countries' entire economies. It had survived for over a century, and it disappeared in less time than it takes most people to plan a weekend trip. Most people assume their money in the bank is just safe, sitting there, untouchable. That's not actually how it works. And once you understand what your money actually is the moment you deposit it, you'll never look at your bank account the same way again. Here's what nobody tells you. The second you put money in a bank, it stops being your money in the way you think. It becomes something else entirely, something far riskier. Something that depends on thousands of strangers you've never met, making decisions you'll never see. So what actually happens to your savings, your paycheck, your mortgage, and your retirement fund if the bank holding all of it suddenly collapses tomorrow? The answer involves a 100-year-old government promise, a psychological trap that has destroyed banks for centuries, and a number that determines whether you walk away untouched or lose everything. Stay until the end, because the most dangerous part of this story isn't the bank failing. It's what most people do in the chaos right after. In this video, you're going to discover exactly what happens, step by step, the moment a major bank collapses, and where your money actually goes. You'll learn about a hidden number sitting in the fine print of your bank account that decides whether your savings are protected or wiped out completely. You'll also learn why something as simple as people talking to their neighbors can destroy a bank faster than any economic crisis ever could. But here's what's really going to surprise you. The safest place for your money might not be where you think, and the bank you trust the most might actually be using a trick that almost every financial institution on earth depends on to survive. By the end of this video, you'll understand something most adults never learn, even though it affects every single dollar they've ever earned. Picture your bank account right now, in your head. What does it look like? If you're imagining a vault somewhere, with your exact dollar sitting in a pile labeled with your name, you're not alone. Most people imagine banking this way. It feels intuitive. You put money in, it sits there, you take it out later. But here's where it gets interesting. That's almost never what actually happens. When you deposit $1,000 into your bank, that bank doesn't lock it in a vault and wait for you to come back. Within minutes, that money is already gone, lent out to someone else, a small business owner getting a loan, a family buying a house, another customer swiping a credit card. This is called fractional reserve banking, and it's been the foundation of nearly every modern bank for over 300 years. Here's the simple version. Banks are required to keep only a small fraction of your deposit in reserve. The rest, they lend out to earn interest. That interest is how banks make money. It's also, quietly, the entire reason banks can collapse. Think about it this way. Imagine 10 friends each put $100 into a shared box, total of $1,000. The person managing the box decides to lend $900 to other people who promise to pay it back with interest, keeping only $100 on hand just in case anyone wants their money back early. For a while, everything works perfectly. People trust the system. Nobody asks for all their money at once, so the box never actually needs the full $1,000 sitting inside it. But what happens if, on the same day, 6 or 7 of those friends suddenly want their $100 back? There's only $100 in the box. The rest is out in the world, tied up in loans that haven't been repaid yet. This single idea, money that exists on paper but isn't physically available all at once, is the exact mechanism behind almost every bank collapse in modern history. And it explains why a financially healthy bank, one with billions of dollars in actual assets, can still collapse in a matter of days. Because the real danger isn't whether the bank has money, it's whether everyone wants it back at the same time. In March 2023, a bank most Americans had never heard of suddenly became the second largest bank failure in U.S. history. It was a bank that specialized in lending to tech startups and venture capital firms. For years, it looked stable, profitable, respected within its industry. But here's the strange part. The bank didn't fail because it made terrible loans. And it didn't fail because of fraud. It failed because of a feeling. The bank had invested a large portion of its deposits into long-term government bonds, generally considered one of the safest investments in the world. The problem was timing. Interest rates rose sharply, and the value of those bonds dropped. Not because the bonds were risky, but because newer bonds paid better interest, making the older ones worth less if sold early. Word started spreading in a tight-knit community of tech investors that the bank might be in trouble. And here's where psychology takes over completely. It didn't matter whether the bank was actually insolvent. What mattered was that people believed it might be. Within about 36 hours, customers tried to withdraw over $40 billion. Not over a few weeks, not over a few days, within a day and a half. No bank on earth, not one, keeps $40 billion in instantly available cash sitting around for a single bank. This is called a bank run, and it has a brutal psychological pattern behind it. The fear that other people will withdraw their money first. It's the financial version of yelling fire in a crowded room. It doesn't matter if there's an actual fire. The moment people believe everyone else is running for the exit, the stampede itself becomes the disaster. The bank wasn't destroyed by bad math. It was destroyed by a feeling that moved faster than any wire transfer ever could. And this is the part that should genuinely unsettle you. That exact feeling can spread to any bank, including the one you use, within hours, thanks to social media, group chats, and 24-hour news cycles. What happened next surprised almost everyone, including regulators. So let's walk through it, step by step, because what happens next is not what most people expect. The moment a bank becomes insolvent, meaning it cannot meet its obligations, regulators step in almost instantly. In the United States, this usually means the Federal Deposit Insurance Corporation, known as the FDIC, takes control. Here's what most people miss completely. Bank failures don't usually happen on a random Tuesday afternoon while customers are lined up outside. They almost always happen on a Friday. Why Friday? Because it gives regulators the entire weekend to take over the bank quietly, find a new buyer or process the payouts, and reopen normal operations by Monday morning, often under a brand new name. This is intentional. It's designed to prevent panic from spreading before most people even wake up to their morning coffee. For most everyday depositors, here's the actual outcome. If you had money in a bank and your deposits were insured, the government guarantees you'll get that money back, typically up to $250,000 per depositor per bank in the United States. This number, 250,000, is the single most important figure in this entire video. Write it down. It is the line between you lose nothing and you lose almost everything. If your money was under that threshold, history shows you typically get full access again within 1 to 2 business days, sometimes even by Monday morning, as if nothing happened. But here's where the story turns dark for some people. If you had more than $250,000 sitting in that one bank, savings beyond the insured limit, that excess amount becomes far less certain. In the 2023 collapse, regulators made an emergency decision to guarantee all deposits, even amounts above the insured limit, to stop the panic from spreading to other banks. But that was a special, extraordinary decision, not a guaranteed rule for every future collapse. This is the part that should reshape how you think about your own money. The system protected people in that specific case. It is not legally required to do so in every case. And this single detail is why financial advisors constantly repeat one phrase that sounds boring, but might be the most important piece of advice in this entire video. Don't keep all your eggs in one basket. including your cash. Now things get really interesting because this isn't just about small or unknown banks. Many people assume that bigger automatically means safer. Logically, that makes sense. A massive bank with billions in assets feels untouchable. But that's not the real reason large banks rarely collapse. The real reason is psychological, not financial. Larger banks benefit from something called too big to fail, the belief, held by both regulators and the public, that letting a massive bank collapse would be so catastrophic to the entire economy that governments will almost always intervene before letting it happen. This isn't a guarantee written into law. It's an unwritten expectation built from decades of watching governments step in during past crises. Here's the unsettling part. That expectation itself becomes part of the safety. People trust big banks more, specifically because they assume the government won't let them fail. And that trust prevents the very bank runs that destroy smaller banks. In other words, the safety of large banks is partly built on a story people believe, not purely on math. This explains something fascinating. During periods of banking instability, you'll often see money flowing out of smaller regional banks and into massive, well-known institutions, not necessarily because the big banks are doing anything differently, but because of where people's fear naturally points. This single psychological pattern can accidentally accelerate the collapse of smaller banks, even ones that were financially healthy, simply because customers move their money out of fear, not facts. And this changes everything about how you should evaluate safety. A bank's size tells you about public perception. It doesn't automatically tell you what's actually happening on its balance sheet. Here's a question almost nobody thinks to ask. If a bank collapses, do you still have to pay your mortgage? Yes. Completely yes. And this surprises a lot of people. Your debt doesn't disappear just because the lender disappears. When a bank fails, its loans, including mortgages, car loans, and credit card balances, are typically sold to another financial institution or managed temporarily by the new entity taking over. You'll likely get a letter telling you where to send your next payment. The terms of your loan, in most cases, stay exactly the same. Same interest rate, same monthly payment, same number of years remaining. This often surprises people in an oddly disappointing way. A part of them hoped that if the bank disappeared, maybe their debt would too. It won't. Debt is one of the most durable things in the financial world. It survives mergers, collapses, and even bankruptcies far more reliably than the institutions that issued it in the first place. This detail matters because it reveals something important about how the financial system protects itself. The system is far more designed to protect lenders and debt obligations than it is to protect individual depositors above insured limits. Your loan will follow you. Your uninsured savings might not follow the bank. Nobody talks about. But the story doesn't end there, because a single bank collapse rarely stays contained to just one bank. This is called contagion, and it's one of the most psychologically fascinating parts of the entire financial system. When one bank fails, especially a well-known one, people don't think, well, that's an isolated incident. Instead, they think, if that bank failed, could mine be next? This single thought, repeated across thousands of people simultaneously, can trigger withdrawals at completely unrelated financially healthy banks. Not because those banks did anything wrong, but because fear doesn't check balance sheets before it spreads. In the days following the 2023 collapse, several other regional banks experienced their own surges in withdrawals, purely from this ripple effect. Two more notable banks failed within weeks, partly destabilized by the same wave of fear, even though their internal financial situations were different from the bank that started it all. This is the part that should genuinely change how you think about banking stability. It's not just about whether your specific bank is healthy. It's about whether enough other people believe their banks are healthy. The entire system runs on a shared belief, and shared belief, as history keeps proving, can shatter in days. So here's where this gets practical, because understanding the danger is only half the story. First, that $250,000 insurance number matters enormously. If you have significant savings, spreading money across multiple banks, or using accounts specifically structured to multiply your insured coverage, isn't paranoid. It's simply matching your strategy to how the system actually works, not how you assumed it worked. Second, Panic is statistically the most dangerous reaction during an actual banking crisis. The data from past collapses consistently shows that people who waited, who didn't join the rush to withdraw everything immediately, were typically protected by the very insurance systems designed for this exact situation. Third, and this is something almost nobody considers, diversification doesn't just apply to investments like stocks. It applies to where you keep your cash too. Having your emergency fund, your daily spending money, and your long-term savings spread thoughtfully, not obsessively, just thoughtfully, reduces your exposure to any single point of failure. None of this requires fear. It requires the same principle that protects you in almost every area of finance. Understanding the actual mechanics of the system instead of operating on assumptions you absorbed without ever questioning them. Here's the biggest insight buried inside this entire story. Money in a bank has never truly been safe in the way most people picture it. It's been protected by insurance systems, by regulatory speed, by psychological trust in institutions too large to ignore. Protection and safety sound similar, but they are not the same thing. Protection has limits, conditions, and thresholds. Safety, in the way people imagine it, doesn't exist anywhere money is actively being used, loaned, and multiplied by a system that depends on confidence to function. And confidence, as we've seen again and again throughout financial history, can disappear in a single weekend. This doesn't mean the system is broken. It means the system was never built the way most people assumed it was. It was built on motion, on lending, on a delicate agreement between millions of strangers who mostly never think about any of this until the one week they have to. The people who navigate banking crises the best aren't the ones who panic fastest. They're the ones who understood the mechanics long before they ever needed to. Now you're one of them. So the next time you open your banking app and see a number sitting there, remember, that number isn't a vault, it's a promise. And the entire financial world is built on millions of people choosing every single day to believe that promise will hold.